Have you ever found yourself carefully budgeting your regular paycheck, but then splurging wildly when you get a bonus or tax refund? Or noticed how easily you spend money from a gift card compared to cash from your wallet? If so, you've experienced mental accounting, a fascinating psychological phenomenon that explains why we treat money differently depending on where it comes from, even though logically all money holds the same value. Today, I'll reveal how this mental trick influences your spending decisions and how retailers exploit this bias to make you part with your cash. Mental accounting is our brain's way of organizing and tracking financial activities. We create separate accounts in our minds for different types of money, and surprisingly, we follow different rules for each account. That birthday money from grandma? That's fun money that doesn't need to follow the same careful spending rules as your salary. That tax refund? That feels like free money, even though it was actually yours all along. This mental separation leads to irrational financial behaviors. Take windfall gains, unexpected money like bonuses, gifts, or gambling winnings. Studies show we spend up to 90% of windfall money while carefully preserving our regular income. My client Michael, a typically frugal accountant, once told me how he blew his entire $3,000 bonus on electronics he didn't need, yet agonized over spending $50 from his regular paycheck on a dinner out. Credit cards exploit mental accounting brilliantly. When you pay with plastic, the transaction feels less real than handing over cash. Researchers have found that people spend 12 to 18% more when using credit cards versus cash. The physical separation between purchasing and payment creates a mental buffer that makes spending feel less painful. Gift cards operate on the same principle. Once money transforms into a gift card, our brain recategorizes it as already spent, making additional purchases feel virtually free. That's why people often spend more than the gift card's value. Retailers count on this behavior. One study found that 72% of gift card users spent an average of 20% more than the card's value. Companies leverage this bias through rebates rather than discounts. When you get a $50 mail-in rebate instead of $50 off at purchase, that rebate check gets mentally categorized as extra money rather than a reduction in the original price. Most people treat rebate checks differently than they would have treated the same amount as an upfront discount. Subscription services and memberships exploit another aspect of mental accounting, the prepayment effect. Once you've paid for an annual subscription, using the service feels free because the payment exists in a separate mental account from the usage. This is why gym memberships are sold annually. The gym knows you'll feel like you're wasting money by not going. Yet the pain of payment is long gone. Tax refunds show mental accounting in action on a massive scale. Logically, a tax refund means you gave the government an interest-free loan of your own money. Yet most people treat refunds as windfalls rather than delayed income. Retailers know this, which is why tax season brings a flood of advertisements targeting refund recipients. So how can you overcome this psychological bias? First, practice the one wallet principle. Remind yourself that all money, regardless of source, has the same value and opportunity cost. That $100 birthday check can buy exactly the same things as $100 from your paycheck. Second, before spending windfall money, institute a waiting period. Give yourself 48 hours to consider how you'd use this money if it had come from your regular income. Would it still go toward that impulsive purchase, or would you allocate it differently? Third, create actual rules for unexpected money. Many financial advisors recommend the 1/3 rule. Use 1/3 for something fun, 1/3 for debt reduction, and 1/3 for savings. This acknowledges the psychological need to enjoy windfall gains while ensuring they contribute to financial health. Fourth, be especially careful with found money, like rebates, cashback, and loyalty rewards. Mentally recategorize these as regular income before deciding how to use them. Ask yourself, would I buy this if I were paying with my salary? Finally, recognize when retailers are exploiting your mental accounting bias. Those store cash promotions that give you $10 to spend later after spending $50 now? They're counting on your brain treating that future $10 as free money that justifies additional purchases. By understanding mental accounting, you can catch yourself when you start to treat different sources of money by different rules. The $5 bill in your wallet, the credit in your PayPal account, and the gift card in your drawer all represent the same purchasing power and deserve the same thoughtful consideration. Next time you receive money from an unexpected source, pause and ask, how would I treat this money if it came from my regular income? This simple question can help bridge the gap between your mental accounts and lead to more consistent, Rational financial decisions.